So how does the accounting treatment change when you have significant influence over the other company that you are investing in? Well, if you own between 20 and 50% of the other company, you are required by GAAP to use the equity method of accounting. Essentially, what that means is that GAAP sees that your two companies are related. You're tied to one another because you own so much stock in that other company that what you say ultimately is going to influence the way that they operate. It's very similar. You still put the asset on your books at the time that you purchase it, but what changes is how all of your subsequent journal entries are accounted for when dividends are received, or when this company that you are investing in ends up reporting a net income or a net loss for the period. Since you are tied together, you are entitled to a portion of their equity, which isn't just a distribution to an investment, which means when they pay dividends, your value of your investment is going to actually decrease. When they have profitability, you own so much of the company, it should entitle you to a significant portion of their profitability, much above the rate of the dividends that they declared. So the equity method is similar to the cost method, but there are a few differences. Purchase, however, isn't a huge difference at all. If Smart Touch Learning was going to pay $400,000 to purchase 40% of the common stock of Klein Incorporated, our journal entry would still be a debit to equity investments and a credit to cash. But now, since we have 40% ownership in this company, we have significant influence. And to keep any investments you have where you have significant influence over the company easily separated from investments that you have where you don't have significant influence over the company, I always create a sub-account for equity investments. So I would call this equity investments - Klein Incorporated, so we can, when we're checking the balance of our equity investments account, we know what portion of that balance is attributable to this company that we have significant influence over. Next up, we're going to have Klein declare and pay a cash dividend of $50,000 on June 30th, 2018. Well, this is an interesting conundrum right here, because they're going to be sending us this dividend. But we are so tied in this company that their loss of value from having to send out those dividends affects the equity stake that we have in this company. So if you're using the equity method, you still record the receipt of cash from a dividend, but instead of recording it as revenue, you actually decrease the amount of your investment in that other company, saying that a company is worth less now because they sent out a bunch of money to other shareholders that weren't you. Therefore, your influence over this company is worth less to your investors. So we're going to debit cash. For how much? Well, we're going to take their total amount of dividends that are being declared in this case. If Klein in total is saying we're going to pay $50,000 of cash dividends to be distributed amongst all of our shareholders, well, we own 40% of the company. We're entitled to 40% of those total dividends. So 40% of $50,000 is $20,000. That's the amount of cash they are going to send us, so we're going to debit cash for that $20,000. However, they are reducing the amount of value their company has by sending out so much cash. We need to reduce the amount of value that our investment has because of that. We're going to credit equity investments Klein Incorporated to reduce the value of that asset. So essentially, when dividends happen in a company that you have significant influence over, you're increasing the value of one of your assets, cash, but decreasing the value of another one of your assets, your equity investments, by that same amount. And you might be thinking, looking at this right now, well, that's kind of weird that, why would we want to invest in a company if we have to decrease the value of our investment? And the answer to that is, if you own enough of another company, above 20%, but less than 50%, when they are profitable, it increases the value of your investment. And to do so, what you're going to do here is you're going to increase the value of your investment every time that company, which you have significant influence over, reports their net income for the period. So Klein is going to report net income of $120,000 for 2018. Well, we own 40% of Klein, which means 40% of that $125,000 of net income they had should be ours. That's $50,000. Well, if they just increase their value and we are entitled to 40% of that value, we should be increasing the value of our investment by that same $50,000. So we're going to debit equity investments to Klein Incorporated for $50,000, and we're going to record this as revenue from investments, or investment revenue, if you will, for that same $50,000. And as you can see on our T account at the bottom, we originally paid $400,000 to buy this large stake in Klein, the company we now have significant influence over. They declared dividends, decreasing their value, and because we have this equity method going on, we need to decrease the value of our investment when the value of the company we are invested in decreases. So we're going to decrease that by $20,000, and that brought it down to $380 at the time, but we just increased it by another $50,000, bringing the balance of our investment up to $430,000. And essentially what we're saying here is, if we sold this company today, we do believe that our portion of ownership in Klein Incorporated is worth $430,000 on the fair market. Well, what happens if we dispose of some of our investment in this company? Well, when you dispose of a company's an investment in a company of which you have significant influence, you remove a portion of the value of your investment equal to what you're carrying it for on the books at the time. So our T account just said that our current balance of our investment in this company was $430,000. If we sold 10% of the shares that we own, we need to reduce the value of our investment by that 10%, and 10% of $430,000 is $43,000. If we sold these to another party for $40,000, which Smart Touch Learning is doing in this instance, that $40,000 that we are receiving is less than our books say our investment should be worth. And since we're selling for less than our asset should be worth, we need to record a loss, in this case of $3,000. So in the journal entry to record this sale of 10% of our investment in Klein Incorporated, we're going to debit cash for $40,000, the amount we are receiving. We are going to debit loss on disposal, or loss on investment sale, if you will, for $3,000, and we're going to reduce the value that we have in our equity investment sub-account for Klein Incorporated by the book value of that portion of our investment at the time we're disposing of it, which is $43,000. Let's do some more journal entries for a company where there is significant influence in the investment that is happening. On January 1st, McFly Motor Company is going to purchase 500 shares of Hillside Insurance, and they're going to do so at $110 a share. This is going to be 30% of Hillside Insurance's outstanding common stock, or their voting stock, and since it's between 20% and 50%, we have significant influence over this company. Which means when we put it on the books, we should, to be good accountants, create a sub-account for this particular company. We're going to call it Equity Investments Hillside, and we're going to put it on for our basis. Well, we're buying 500 shares. We're buying them at $110 a piece. That means we are buying these shares for $55,000 to make a significant investment in Hillside Insurance. And we're handing them cash, so we're going to decrease cash by that same amount, that same $55,000, when we invested in Hillside Insurance's stock, and we're going to use the equity method. Next up, on June 30th, Hillside Insurance is going to pay a cash dividend in total of $1,500, and that is the dividend not just to us, but to all of their shareholders. Well, we own 30% of the company, so we should be entitled to 30% of that dividend. So we take the $1,500 dividend, we multiply it by 30%, and we come up with $450. We're going to record that receipt of $450 of dividends from Hillside Insurance by debiting cash for $450. But since they are paying out cash, in this case, to their investors, their overall value of their company is going to be decreasing, and we are tied to them, which means our value of our investment in that company has to go down as their overall value goes down. We're going to decrease our equity investments, the Hillside account, by that same $450. In the journal entry to record the dividend from Hillside using the equity method. And then, if in the future Hillside is going to report net income for the period, net income means that their value should go up, and because we are tied to them, the value that we have in our investment in that company should also increase. If they had $50,000 of net income and we own 30% of the company, we should be entitled to 30% of that $50,000, which is 15 grand. We need to increase our investment in that company on our books, so we are going to debit equity investments to Hillside for that $15,000, and we are going to record that investment revenue at the same time by crediting it for the same $15,000 when we record the revenue earned from our investment in Hillside during the period. And at this time, what is the book value of our investment in Hillside using the equity method? Well, we had a debit for $55,000 when we acquired that 30% ownership to start with. We decreased it by $450 when they paid dividends out, and then we increased it by $15,000 when they reported net income, and we accounted for the portion of the net income which is attributable to our ownership level. So right now, the balance of our equity investments in Hillside Insurance T account should be $69,550. Well, on January 1st, let's sell a portion of our ownership in Hillside Insurance. We're going to sell 500 of these shares at a price of $160 a share. And if we're selling 500 shares at $1.60 a share, we're going to receive $80,000 in cash. Well, our cash received is going to be 80 grand. What is our book value? Our book value is $69,550. We're selling all of our ownership in this company. So if we find the difference between what we're receiving and the book value of our investment in that company, that's going to come out to be a total of a gain of $10,450. Well, what do we have to do in the journal entry? We have to record the receipt of cash for the sale of these 500 shares, which is $80,000. We need to remove this investment in our books. We just sold our ownership, so we're no longer invested in this company. We're going to credit equity investments in Hillside for that same $69,550, and we are going to record that gain on the disposal of this equity investment for $10,450 when we sold the entirety of our investment in Hillside Insurance.